Hey guys, we're still waiting on Kevin. He should be on in just a second, but just going through the basics just to start off. It's super interesting market the last couple weeks actually. So if we look at it, I like to always go through the equity sectors, figuring out where the strength has been, where it's going to be. Obviously, technology has been leading the way, something that a lot of people continue to kind of discount over and over again, which is the idea of relative strength. If you have strength in something, it usually continues. Most people, and they think of trading, they try to think of it in a way that's um, you basically look at the markets and go, okay, I'm looking for what's on sale, and really like your best idea isn't ever going to be looking for what's on sale. It's always going to be finding the winners, and how we do that is finding relative strength. There's a very old article, if you Google Meb Faber, and this is where a lot of people still get their ideas of relative strength and how to use them, which is finding the top three sectors over a 3 month time frame and owning those. And if we look at what's the top three sectors in a 3 month time frame, you would see utilities, technology, communications, consumer staples, healthcare. I like to go a little bit further out than that. I think that's a little bit too short term for me. I like to do the year to date or 6 month time frame. And if we look at it on a 6 month time frame, we're seeing that technology, communications, utilities, financials, consumer staples, and all of these things are above 10%. And if we look at the S&P 500, which is at the bottom, the S&P 500 is at 15% year to date, and most of those gains are driven by one sector, which is technology. Technology is really leading the way, and as technology continues to lead the way, sorry about that, just wanted to check on Kevin. But as technology is leading the way, we want to be in the things that are leading the way and out of the things that are basically going to cost you money. So if we look at real estate, like we don't want to own real estate, we don't want to own consumer discretionary, we don't want to own materials. These are the sectors that are kind of laggards. The laggards you don't want to own. You want to own the leaders. If we look down to here at semiconductors, we see semiconductors in a 6 month time frame is up 53%. Year to date 52%. If we go over just I think on a 52-week high, like how close are we to a 52-week high? We're right there again. I mean, this is where the strength has been. So looking at the markets in general as a whole is something that we always like to do. And this is why it's important to understand like the macro, understand commodities, and just going over the performance over the last, and I always like to go over the 1 month performance for everybody. Still, commodities are kind of leading the way. It's a little bit thinner than it was a couple of weeks ago or a month ago. Cocoa, 41% in the last month, which is wild. I wouldn't have expected that. Coffee up 5%. Ethanol up 5%. The Nasdaq is up 5%. Crude oil though is starting to show some strength at the moment, which is kind of interesting. It had that big crash all the way down. We talked about it, the possibility of it making a turnaround and reasons why this could happen. And now we're up. I had a small short-term target rate to 80 on a false breakdown signal, one of my favorite signals. It bounced up to 80 quickly. It's above 80. I think it's at 81 right now. So Brent right behind it, the S&P 500. Sugar being an interesting one, and maybe Kevin can add a little bit to this one because I know he knows everything about everything for the most part. But if we're looking at sugar here, we're seeing the commercials are starting to actually get very interested in this. And this is something that doesn't happen a lot. Sometimes it happens in these bear market style periods where they're just accumulating, accumulating, accumulating. And then when it's in a bull run, it doesn't happen a lot. You'll see, they get to net long here, they get to net long there, they get to net long here, and that's always at bottoms. And now we're hitting net long again, in the middle of, you could say it's a bull run if you have the commodity super cycle view. But I'm more just saying it's a pullback. We're hitting net long. Kevin, have you been looking into sugar at all?
I have, and I'm actually trying to pull up the report because I believe the USDA actually reduced the production estimates for this year.
Can't hear you. Are you on mute?
Oh.
Well, while Kevin's figuring that out, let's look at another one that was quite interesting recently, which was cotton. Cotton is absolutely looking insane. Same setup we're seeing here, but once again, there's a lot of reasons why we might like cotton and why we might dislike cotton. Cotton most of the time kind of becomes a China story. Kevin's going to log in back in 1 second, but cotton becomes a China story most of the time, and so we really want to sit on our hands when we're looking at cotton. But this extreme heat that we're seeing in the Midwest, the extreme heat we're seeing in the South, where we grow a lot of cotton, that's going to put some major pressure on the cotton market. So looking at cotton, another one that has a great COT signal here, but you don't really just want to buy. That's the other thing that you have to know. You don't want to just buy when there's a COT signal, meaning we got COT buying, meaning commercials are starting to buy, the hedgers. We want to wait for some momentum behind the move. We don't see that yet, but something to put on your watch list is definitely cotton. Kevin, can you hear me now?
Yeah, can you hear me now? No? Nope. That is so weird.
Kevin?
All right. Yeah, can you hear me? I'm showing that I'm showing that I can talk.
Okay, you're good, Kevin.
Can you hear me now?
Yeah, you're good. You're good.
All right.
Okay, go ahead, Kevin. You have any thoughts on sugar?
Outside of the fact that I need some right now. All right, so sugar. So I believe that the USDA actually reduced the production estimates by a tiny bit from the latest WASD report when it comes to sugar. And I think the demand for ethanol production, especially when you're looking at South America, has kind of potentially bottomed out here a little bit, which I think is kind of probably giving rise to maybe some long positioning taking place right now. But I still feel like we have a long way to go in order to try to like really define that uptrend from a fundamental standpoint. So as you kind of talked about it, commitment of traders maybe showing some strength there. The fundamental data from estimates kind of getting there. Let's see what the ethanol side of the business is really going to show. I think that's going to be the main driver when you're looking at sugar and basically crush production when it comes to sugar right now.
No, I agree, and it's interesting to kind of look at sugar and the cotton market at the moment. Both have extreme commercial buying. Usually, this puts in bottoms. It's not something that you want to trade on. Like for me, I'm not a person who goes, "Hey, we have extreme commercial buying. I want to buy right now." It's something to keep an eye on. Wait till that reverses because there's so many things that go into those reports. You can't just look at it in a vacuum and say, "Hey, these are extremes. We need to buy today." So with all those things kind of going into the reports, what are you thinking about cotton here, Kevin? That's another one that I was talking about. I just brought up in my Substack yesterday, talking about it a little bit.
Yeah, cotton's actually a very tough one because there's an ample amount of supply that is out there, and then also demand hasn't really sparked as much as what people would have expected. But the tailwind for for cotton, and I'll send this over to you here in a second, is the crop conditions. And the crop conditions, especially when you're looking at North Carolina, has deteriorated, at least for last week. And I think that may have caused a little bit of buying activity potentially in cotton. But once again, when you're looking at the fundamental demand landscape there, if we hit our production targets here in the United States, global supply should be there. And that's a headwind. But if you have crop conditions that are volatile, that's kind of where you can get these 1 week, 2 week swings as a weather play. The weather plays, as we talk about with pretty much any commodity out there, is very difficult to be able to try to pull off. And as soon as you get your spike, you usually don't want to hold on for too much longer unless you have a fundamental thesis around it. For instance, coffee, cocoa, right? Ivory Coast had issues, wind issues, drought issues that kind of led to this overall fundamental theme of shortages that are not going to be backfilled. That's a weather catalyst that kind of remained and accelerated the demand picture. Cotton's not there yet. We already have ample supply when you're looking at ending stocks for last year. But if you kind of get that weather event, especially in certain areas or production areas that we really are focusing on, Mississippi, North Carolina, when you're looking at the good to excellent crop areas, if you get some significant fluctuations there, you get some storms. Those are the type of things that'll really drive price. But if you're asking me, do I see a demand thesis there? I really don't right now. I mean, we're talking about a situation. We're talking about a situation domestically here in the United States where the consumer might be a little bit stretched. Now, the majority and a lot of our cotton production is going overseas, right? But you would need to have the overseas consumer really like thriving right now. And you're looking at retail, textiles, that demand trying to go up. Are we really seeing that right now when it comes to earnings announcements and other economic data? Not really. So tough trade, but for cotton, you brought up the Commitment of Traders report. It's already significantly shorted. So you can make the cases, how low can it go from here? And the answer of that is always, it can go lower, right? It always can be, it can go lower, but it is already stretched when you're looking at the short positioning. So what's going to be that catalyst in order from a demand side to really kind of spark that short covering situation, then leading into longs, getting into the position, just like we saw with natural gas, significant short interest taking place. Boom, you had like a fundamental thesis catalyst that kind of kicked it off. You had the weather kind of kick it off. And then you had those shorts being squeezed out and you had new longs getting in, creating this domino effect to the upside as we hit like what, 305 or something like that on natural gas. Cotton can do the same thing, but I just feel like it's a little bit difficult right now based on the macroeconomic data.
Yeah, I mean, cotton's always the toughest story. You know, like even the trends that happen in cotton, they're driven by so many different things. You know, cotton is it's kind of one of the hardest things to trade. I think in general, it's very similar to natural gas, way less volatility. So nobody's ever going to call it the widowmaker, but it just kind of does whatever it wants to do at times. Sometimes it gets so far out of the fundamentals that it doesn't make sense. Sometimes it's just going to have right now, for example. But the one thing that we can always pay attention to is the positioning, the long interest, the short interest. If we're looking at the positioning and going, okay, we have, and the reason why this is important is this. So if everybody is short, who is left to sell? So think about it in extremes. You know, in extremes, it's 100% short interest. That's never going to happen in history. However, if everybody's on one side of the boat, you have to get to the other side of the boat. So the next thing you know, the market can move up. And this could be a catalyst to move higher. There would have to be another part of that story. Now, once again, just like Kevin said, and that's what I mentioned earlier, is like there's a lot of things happening. You know, there's flooding in crucial areas in Texas and the Deep South. Kevin also mentioned North Carolina. We have some drought conditions and some extreme heat in the United States and other areas. This can create a lot of blight situations for some crops. Cotton, that usually doesn't happen in cotton. So it's, you know, we could have all of these things kind of come to fruition, or it might not. I think the thing that Kevin might be able to speak on this a little bit more too, which is I think it really comes down to something like China. You know, the China situation would have to change. Demand from China for more stuff for us in the United States would have to probably be the driver there. I just don't see it right now. You know, so Kevin, do you see any of that China driving this move higher in cotton, or do you think that's far off?
I don't see that actually happening right now. So let's say for net export sales right now ending, we don't have the updated data for yet for today, but net export sales for cotton 189 and some change. Next week, looking for a little bit of a bounce there, but when you're looking at it from a relative basis, I think that's more seasonal than anything. And I really don't see China really ramping up when it comes to cotton. Now, China is ramping up when it comes to beans, though. So that's something to note. But for cotton, not so much. I mean, there's export demand that's kind of showing up, but just be mindful the inventory levels that people already have in their stockpiles are still relatively high. So generally, what you will see when we have these type of markets, especially with high inventory levels, ending stocks of last year are usually the first ones to get drawn down, right? And then you basically place orders to be able to backfill whatever you drain out of your excess inventories. That's the way that this thing goes. But if we don't see a significant draw within the cotton inventories right now that we already have, then it's really hard to see that demand picture really backfill that until something dramatically changes. Now, China, in their stimulus measures, in order to try to spark consumer demand in certain respects, can be a tailwind for them. But just I feel like it's a hit or miss. There's a lot of nationalization when it comes to consumer purchases in China, a shift in nationalization across the board, right? Where you're looking at electronics, even like the Lululemons of the world and stuff like that. Like you're seeing a lot of Chinese consumers really just trying to buy China and not really trying to buy US. And I think that's more geopolitical than anything. I don't think that's going to really make everything fall off a cliff, but I think there is going to be a side there where that's a headwind when it comes to cotton.
No, I agree, and it's going to be the sit on your hands trade for a while. I think that range in cotton that's kind of come out, that could be it for a long time. It could be some fun ranges to trade. These like we're saying, we have weather events, we have short interest, you have certain things. They could be ranges to trade, but a new trend in cotton probably pretty far off.
Tough. Yeah,
that'd be tough. So you sent this. This is a crop report. So what are you looking at here, Kevin? So we can explain this to people who don't usually look at this stuff.
Yeah. So one, this is I didn't build this out. This is from the Hightower report, which they are a really great future service to get a lot of data from. Good analyst over there. Now they are kind of making some adjustments when it comes to their coverage for the time being. It seems like they're looking for new analysts and things of that nature. But they have a crop conditions report for pretty much every market. And so you have a good to excellent crop and then poor to very poor crop. And then what this is really showing is the percent change basically of sentiment on those crop conditions on a week by week basis. So when I brought up North Carolina, you could see that the good to excellent crop in that bucket, the quality of that bucket, when you're looking at the conditions itself last week or this on the week of the 16th at 66%. Before that, it was at 81%, meaning when the number goes down, meaning the crop conditions are not great, right? They're going lower. Now, these numbers are very volatile. They change on a week by week basis. So if you kind of analyze this to last year, which is the number to the right of that -15, when you're looking at North Carolina, that last year, at this time last year, crop conditions were sitting at 69%. We're at 66, a little bit lower than what last year is. And if you're looking at the 10-year average, 67%, we're a little bit lower than that. So that's really what this table is going to show you. And it shows you this on pretty much every crop that is out there. But they basically take weather reports, you get sentiment from farmers, and they say, hey, how good's your crop this week? Good, bad, or indifferent. There's another report when we were looking at corn, which was actually very interesting as well. I know I'm going off the beaten path here, but the reason why I bring it up is because we're talking about this crop conditions report. So corn last week, Illinois saw a significant drawdown when it came to the crop conditions for the good to excellent crop. And that's really the ones that I focus on. And so these reports that we get can actually move price. This is kind of that a part of that weather cap that's out there, or the quality cap that is out there. So if Illinois is having some issues because it's excessive heat, excessive humidity, that could lead to disease, that can lead to stunting of growth, that could lead to a whole bunch of things. If they have that for too long and the quality kind of diverts off of what the average is, if the quality is going less and less, then guess what? The price for high quality corn goes up, right? So you can have like some of this relationship. And when we talk about corn contracts or any contracts that are out there, cotton or even crude oil or what have you, it's a barometer of a bunch of different qualities of that particular product, right? So there's corn, but there's different grades of corn. There's different uses of corn. There's different varieties that are used for different products, right? That corn price that we are looking at is kind of that aggregate blend that the market uses as a reference point to be able to hedge their product. There isn't going to be a corn product that's completely ethanol grade corn, right? There's no futures product for that. It wouldn't be a liquid product. There's nothing that's out there that says sweet corn, which we don't export sweet corn. We consume pretty much all of it. There's no contract that's just dedicated to sweet corn. You kind of aggregate that whole, all of those different industries, all of those different use cases into what we have now, right? Cotton's the same thing, different quality of cotton, right? And so you're looking at a blended price, and that's really what I'm trying to highlight there. And that blended price, if you have quality corn or quality cotton being damaged, and the scarcity of that quality cotton continues to go up more and more, then that should then synthetically, for the most part, potentially raise prices in a sense.
No, that's perfect. And I think that's one, you have to pay attention to those reports because the other thing that's interesting is that people don't pay attention to it, and they start to trade commodities and they go, why at noon does this happen? And they're not, they have no idea what these reports are, where they come from, how they exactly work. It's a good explanation. But yeah, so let's keep going through the macro landscape. Any sectors that are sticking out for you right now? Thought it was kind of interesting to see energy up so much yesterday. For myself, it was up 2% while the market was flat. That's quite interesting to just see from from energy. Whereas technology has been leading the way, over all time frames. Actually, if I look over a half year, 3 month, 1 month, technology continues to lead the way. So are you seeing anything interesting in the spider sectors?
Okay, yeah. So let's talk about energy. So I look at weekly charts. Energy, if you're looking at the XLE, which is heavily weighted in the top integrated Chevron, Exxon, right? So we have to keep that in mind. But we had this wedge pattern that was kind of taking place, right? And we're pretty much at the apex of that wedge pattern on a weekly chart. In that weekly chart, we were testing the 50-week moving average when you're looking at XLE. And so we did see a bounce. How much can we sustain that bounce? That's going to be a question. And the thing is there's a proxy that people utilize, XLE, to be able to translate into their oil exposure type of play. And you just got to kind of be careful with that. I always just kind of caution people on that because they can disconnect, right? You're trading a company that has its own internals, has its own margin ability, it has its own geopolitical risk, it has its own logistical risk and things of that nature. But holistically, decent bounce. But let me tell you, the resistance level for this bounce is going to be sitting at around $93.75. Let's say 94. That would be kind of the upper end of that particular channel, this ascending triangle that we do see here. You want to be able to break out of that on very large volume, and what's going to be able to be that catalyst for that? Defensive play, maybe. When we used to look at energy, let's say 6 months ago, 8 months ago, energy could have been a defensive play because prices were elevated and sticky because I'm going to say 3 months ago, because the prices were elevated and sticky and the fundamental thesis was there. The crack spreads themselves were fairly profitable, sitting at $32, $33 for that 3-2-1 crack spread. Now it's a little bit of a different story. That crack spread has actually deteriorated in value, trading at around $24. So the margins, when you're looking at these companies and their internals, theoretically should be going lower, and it's going to be tougher for them on an earnings basis, which is why you kind of saw the integrateds actually pop into the upside, the exploration companies pop into the upside. But when you're looking at refiners like the VLOs, the Valeros, the Phillips 66 CEO came out on Monday or Tuesday and stated, hey, our margins are not great. And the gasoline demand when it comes to the summer driving season is lackluster, to say the least. It's not where we expected. And we saw refiners sell off. So you want to be very picky when it comes to your energy companies and just be mindful that once we get to earnings season, the next 3 weeks, 4 weeks from now, well, I believe the energy companies are going to report in about 4 weeks from now. Once it gets there, you got to be very careful. Because I would not be surprised if Valero comes out and says, hey, wasn't great. Like we did see a compression. I wouldn't be surprised even if Exxon, which has had issues when it comes to their chemical business and the midstream side, say, look, chemicals is still hard. The chemical business is a little difficult. And then our gasoline business, which was kind of giving us some tailwinds, is also being a little bit difficult as well. I'm not saying I'm negative on energy stocks by any stretch of the imagination. It's a nice bounce. But I think there's a scenario where we have a little bit of a bid in oil. We also have quarterly rebalancing too. So that can actually provide positive inflows for sectors that usually don't get a lot of love, and people trying to rotate out of tech, as tech has been kind of seeing some headwinds over the last 2 trading sessions. Those type of dynamics, I think, are really kind of fueling this right now. And you can make a play off of it for sure. Just be mindful and know that the earnings picture might not be as rosy as what we kind of expected, or what could have been expected a month and a half ago, 2 months ago, when oil was still trading in a healthy range between 80 to 85.
No, that's a good point. And we also have triple witching today, something to
Yes.
just talk about, which is also important, meaning, you have monthly options expiration, futures expiration, and God, I'm slipping right now. What's the other one?
Equities. Yeah, equity indexes expiring,
Equity
you have equities, quarterlies expiring, you have futures indexes expiring, and then you have futures options on those indexes expiring. So those are your four.
Yeah, in my brain, I guess I get to the futures, and I think that's the indexes, and
Yeah.
too much of a futures trader these days. Anyways, so when we're looking at the market and going, okay, we have triple witching. Some people used to call it quad witch when we had the single stock expirations. Nobody
Yeah.
ever really traded those much, but triple witching, I always look at it and go, okay, where's the market possibly headed? Are we at a turning point? Is the market in a downtrend? Is the market in an uptrend? So sometimes when you have this type, and what Kevin was talking about earlier, which is also good to also mix into this thesis, which is when you have quarterly rebalancing, you have a triple witching event. Most of the time, this gets rid of gamma walls. And so what we mean when we get rid of gamma walls is these extreme areas where there's a lot of open interest for options. And when we kind of get rid of those walls, the market can kind of move in a direction that it really wants to go, basically whatever the path of least resistance is. You see a lot of the time when you think of March 2020, that was a great triple witching day where the market basically turned back up right after that. So basically what I'm trying to say is when you get to next week, pay a lot of attention to if the market's rotating into some of these sectors that aren't getting much love, like Kevin mentioned. Start to pay attention to if the market starts to struggle, like tech. If let's say tech starts to struggle, it's been in this strong uptrend, it's been outperforming everything. What if it starts to struggle up here because of this event today? So I like to pay attention to those things around that time, because that's, for me, it's the best way to find bottoms, it's the best way to find tops, it's the best way to find quick trades at certain times. So another thing to kind of pay attention to in the macro scape. But yeah, I really like the energy trade is really interesting. And if I have a 1 year thesis on energy, I say energy is probably a lot higher. If I have a 2 month thesis or a 1 month thesis on energy, I say we're probably in for some volatility. I think the thing that a lot of people aren't keeping in mind here is we're in an election year. In an election year, or just generally every year, let's just talk about every year, because summers are rough as a trader. Something you always have to just be ready for, understand. You're going to deal with volatility. Your returns that were killing it the first 4 months of the year are all of a sudden going to become very stagnant. You're going to get chopped around. You're going to hit a lot of stops. You're just going to get a lot of volatility. And so in an election year, especially, we're going to see this summer. July usually is a good month. July, usually we have a good rally. Technology usually leads that rally. But after that, I think August, September, October, we'll start to see some volatility come into the market. And as we see that volatility come into the market, we got to pay attention to, hey, this is going to be more sideways than up. Manage your expectations. Don't have the expectation that the market's just going to trend higher the whole time and everything's going to be great. Be ready for people to start flipping their positions heavily before the election. People going, oh, hey, this could be a very bad election, or other people being too optimistic. You have that kind of pulling the market in two different directions, which kind of ends up in a tight range. And then we usually break out of that range at some point after the election, right after the election. But, for now, I think it's important to just kind of think of everything in a few month time frame and a 1 year time frame, and seeing where you fit in as a trader.
Yeah, I would say, though, if you're kind of looking at the energy sector, didn't do that bad under Biden.
Mm-hmm.
Production levels were so I'm gonna get some pushback. Production levels have been up under the Biden administration. Now, you can make a case that maybe it was some of the policies from the previous administration. I'm not going to get into the politics of that. I do believe that that's the case. I think there's a 2 year lag when it comes to any type of fiscal policy that's put into place. But just know that the current administration has run an out of sight, out of mind policy for energy, because they understand the dynamics that are going on right now under the surface when it comes to inflation and when it comes to the geopolitical landscape that's out there, right? So we've had this on the surface, like, hey, you know, energy's bad, fossil fuels are bad, and then under the hood, it's kind of like, all right, go ahead and do your thing. Like that's exactly what's going on right now. The production rates that have been going up. So I think if you're an energy trader, you could say, all right, we've already seen this story before.
Mhm.
I hate getting into the politics of this, but it's not political here, guys.
It's not political.
This is a true fact.
Yes.
If you look at the policies under the Trump administration, kind of opposite. Drill, baby, drill. We're gonna do all of this stuff. There was an approval of some land off the coast, I think Maine, where he's like, oh, we're gonna approve this in order to drill oil, and literally nobody wants to drill oil there at all, right? So more symbolic gestures, but if you look under the hood, a lot of the production or the encouragement of production was actually in the Middle East. It was actually Saudi Arabia. That's not a conspiracy. That's not something that's like, oh, I don't like Donald Trump. That is literally a stated fact. You can ask Dr. Anas. He's a really good analyst. I would suggest everybody follow him, read some of his work, and he'll say the same thing. And he bashes on the Biden administration, literally almost every single publication that comes out there in a sense, right? But even he will admit, and he even states, hey, you know what? This is actually beneficial for the Saudis, rather than what we saw for domestic production in the United States. That's not a political statement. That is hardcore data and facts. But we've been there before as well, right? So I don't think if you're looking at the energy sector and the election risk, I don't see there's a lot of election risk for energy out there right now, for fossil fuels for right now. And if we continue to have the geopolitical issues that we're having with Israel and as well as the Ukraine-Russia conflict, the underlying risk of oil supply shocks is still going to be there. I don't think that they're going to transform that policy. Now, the Biden administration, from the natural gas standpoint, has been a little bit tougher when it comes to LNG exports and trying to expand the refining operations there, right? If we see a reversal of that policy, that's where you could see natural gas really catching a solid bid because demand is there. But I don't think there's that much of a risk when you're looking at the energy patch. You're going to hear a lot of rhetoric, but we are here, you and I are here to kind of cut through the BS and let you know at the end of the day, I think it's going to be all systems go regardless of where we're going. We're not going to, no one's banning energy, no one's banning gasoline or internal combustion engines by next year. You have California trying to enact those plans. That's not going to work. And California knows that too. It's a political year, right? They're trying to force, now it's like diesel. They're trying to get rid of diesel locomotives, which is like 65% of the overall total fleet in the United States. And that's not going to happen, right? So take the politics out of it, energy sector and the election year, a lot of talk. But when you're talking about hardcore numbers and dollars here, either way you go, I don't think it's going to be a major headwind for them, honestly.
No, that's a good point. And another thing to talk about too is if you go back to the 2020 election and you go to the just look up. I know this is still like because it was a huge article. It was on everything, and every analyst said the same thing, which is if Biden wins, you want to buy solar, you want to buy tech, you want to buy this, and if Trump wins, you want to buy banks, energy, and industrials. And then the reflation trade that year after Biden won basically was the trade. So basically banks, energy, those were the outperformers. Technology became an underperformer for the first time in a while. So once again, you just have to really, cut through the noise, do the research for yourself, like listen to people that you actually trust, because once again, it's not that anybody has it like nailed out perfectly. And I'm not even hating on the people writing these terrible articles. Like they're all writing their things. They're doing their own thing. That's what you do as an analyst. But then there's the people who are actually in the markets. Like Kevin's a trader. I'm a trader. Like when you're actually in the markets, you see what's actually going on in the markets. So being able to report like what's actually, like when we were talking about inflation at the beginning of this year, we're not talking about it because we're reading CPI data alone. We're also seeing the actual reports, like what's actually coming out, what the refiners are actually doing, what's the price action doing. All of these things are incredibly important, and more important than just reading stuff online. So I think it's really important. It's something I was talking about with a friend of mine, which was the trader's journey, which is when you start to look for signal services, basically somebody that's going to give you a bunch of trades all the time. You find out that that doesn't work. You then find like some an analyst, like something on Bloomberg or something. You're going to read news headlines, and you find out that that doesn't work. And then you find an analyst, then you find out that that doesn't work, especially the fear mongering ones. And then you get into the ones where you're like, okay, this person is just teaching me how to trade, how he trades, or how they trade. That's something to pay attention to. Okay, great. But then you got to go to the next level, which is, now where do I get my data? So Kevin and I put out a really good video on COT data and all this stuff on my YouTube page. So I'll put that in the comments here on YouTube. But once again, you really want to find your own data sources. That's so important. Find your own data sources, find your own things that you're going to pay attention to. I like stock charts
and conflicting ones.
Yes, and conflicting ones. Yes, and conflicting ones. Talk to people that you get into arguments with sometimes.
Yes,
but like don't block everybody that you get in an argument with. Like, that's incredibly important.
Yes. No, that's really important. You want to get to both sides of the coin and then kind of come up to your own judgment, right? That's going to be key. Let me go back to solar. You brought up solar, right? And so solar's falling off a cliff right now. The solar play, if somebody says, hey, Biden wins, solar is going to win, Biden has nothing that he can do on solar outside of signing a bill. Mm-hmm. Everything is really going to be focused on Congress this year. We're focusing on so much of what's going to happen in the executive branch, and the executive branch means a lot, but Congress means even more. Congress is going to be the ones that either passes the extension of the tax cuts that Donald Trump passed, right? They're going to be the ones that continue to extend that, because if we lose those, there is a risk that we do see some churn in the market because of taxes going up, right, for corporations. But if you have the Democrats controlling the House, maybe that's when you can actually extend some of the solar credits that are out there that are about to expire. And that's the biggest risk. So it ain't so much like what's going to happen in the executive branch, yes, but what's going to actually happen in Congress. The Congress actually does control the purse, and they're going to be the ones that actually do control fiscal policy. That's going to be the key area of focus here for this year, in my opinion.
No, I like that. Now I answer a question here. I know you got to go, Kevin.
Yeah, I got to go in like 5 minutes.
Okay, cool. Yeah, quick question on the U.S. dollar to the yen as an indicator and how I use it, which is so this is a conversation from when Kashap and I were talking a couple months back, and we were basically talking about intermarket analysis. But one thing we talk about with intermarket analysis, that's the most important thing, which is relationships change. So the yen was always kind of a safe haven currency. It was a safe haven deflationary currency for a long time. Same with the Swiss franc. As these can be safe haven currencies, there's also other issues that kept building in the yen over years of easy monetary policy, negative rates, and so on, that put so much pressure on the yen that it's really not what it used to be. However, there are other intermarket analysis that I really like. Copper to gold ratio is one of them. That's a great one. Another one is CRB to USB, meaning the CRB, which is the commodities index, against US bonds. The 30-year is what I use. Things like that are still really great things to use. I would continue to just look into those. And you can check out our page. I post those every single week usually. So you can check out our page on our Substack. And once you find that, you could basically hit us up, ask questions, feel free to just ask anything. I'm happy to share any of the tools I use.
So, and I do apologize. I know that I've been like on the computer a lot, but I'm trying to send over a couple of stuff as they come in. So we're running a little late here. I wrote an article today because we're bringing up the U.S. dollar or Japanese yen. So there's a significant development that is taking place. Not fear mongering. This is once again 100% fact.
Real quick, I'm just going to put that in the comments for everybody.
So. Yeah. So check that out. So there's a Chinese bank, Noshokin Bank. It's the fifth largest bank when you're looking at total dollars or asset amounts. I'm not going to go to the whole thing, but when you're looking at US dollar or Japanese yen, and we're talking about this carry trade or the reverse carry trade that's taking place, this is the first big, large financial institution that is feeling a significant squeeze on here. Basically, this institution borrowed very cheap funds, very cheap capital, went out and bought US debt, European debt, collateralized loan obligations, which are not the greatest, but there's some decent chunks in there, but not the greatest. Very high leverage, and they were basically trying to buy yield. They were buying yield. They thought, hey, interest rates are going to be going down here, and the higher for longer strategy basically killed them. Now, this bank is not going under yet. They don't have a flight on their asset or on their deposits like we saw for SVB. They're agricultural co-ops. They don't have the same type of dynamic that we saw with the SVB situation. But the reason why I bring it up and I wrote about it is because it's very important to understand that carry trade and the yen, if the yen continues to weaken, no matter what happens to those bond prices, they're incurring greater and greater losses. This is one of the biggest examples that the Bank of Japan has to figure out what's going on with the yen and has to take action. But guess what? They're doubling down here, Jason, and that's where I feel is very interesting. So they're raising what? They're raising a bunch of capital, right? They're about to take around a $9.4 billion hit when it comes to these particular assets here. They're trying to raise around $7.6 billion in capital. They're selling $63 billion worth of US treasuries and European government treasuries. And they're going to take all that money and they're going to buy JGBs, Japan government bonds. And they're going to buy more collateralized loan obligations, CLOs. Here's the problem. Are we going to cut rates in the United States? Most likely, yes. We don't know when, but it will happen. Are we going to see the ECB cut rates? They already did. Mm-hmm. Who's the only central bank right now that's actually raising interest rates?
Ooh.
Bank of Japan. So why would you take capital that you already got burnt on because you were buying yield, right? And buy into a product that you literally know that they're going to raise rates. As they raise rates, guys, prices of those bonds go down. So why would you go and buy domesticated yields right now for the only central bank that I know of, major one, that's raising interest rates, raising them, doubling down? This is what not to do in order to try to manage risk. And that's why I wanted to write that and bring that up. To put it in perspective here, the fifth largest bank here in the United States is Citigroup, right? Equate that to their Citigroup. And imagine Citigroup taking those astronomical losses. They estimated these losses 3 months ago to be 3 times less than what they actually are estimating now for the month of March. Now, they're going to be selling these assets up until March of 2025, but it's a problem. And this is something that you're seeing it on a bigger scale, but there's a lot of institutional traders out there, and you and I know them, a lot of hedge fund traders out there that have the same carry trade risk.
Forever.
That are going to feel the same type of scenario here. And it puts the BOJ in a bind, because if the BOJ continues to raise interest rates, now they don't raise them as aggressively as we do. We raise them 25 basis points, right? They're doing theirs at around 10 basis points. But they have to kind of raise it because they are seeing kind of inflation happening, and then they want to be able to strengthen the yen. One thing has to break. Either the yen breaks, and it's already broken. It broke at 156. 157, right? We already had the intervention, continue to move higher. It's trading at 159 right now. Yen breaks, already done that. Or they keep rates where they are at when it comes to the JGBs. And this company and this bank here is kind of banking on the fact that their existing portfolio, they're not selling out of all of their US treasuries, but the existing portfolio, the Fed will cut. That'll help them out here a little bit. And they are banking on the fact that the yen will strengthen And the BOJ will not aggressively cut rates, raise rates at all, and they'll probably leave them at these levels. And that's a hell of a risk. So that's what I got, man. I always appreciate you, Jason. I really do.
No, man, thanks for coming on. This was
Sorry,
great.
I came in a little late.
Glad we covered. No, you're good, man. I'm glad we covered a bunch of different stuff today. That's the plan of the macro show at the end of the week. Don't want to call it the macro show. There's like 50 shows named that. But on this show at the end of the week, our goal is to mainly go over a bunch of different things that could be catalysts for you guys to pay attention to. And this is a great thing to end on. Thanks, Kevin. Appreciate your time, man.
For sure, man. Well, we'll look at it next week.
Yep. I'll see you guys on Monday around 11 a.m. Eastern time. And we'll see you soon.